Hi everyone, and welcome to this week's edition of Finance on Your Terms. As always, I'm Mike Benasiak, and thanks for joining me. So I want to continue our investment discussion and talk about the difference between two general types of investments that you may have heard about: stocks versus bonds. And there's a lot of complexities in these things that we can get into, but I want to try to keep it simple and break it down for you. So when it comes to stocks versus bonds, the easiest way I know how to explain it is that it's the difference between ownership versus loanership. So let's talk about stocks first. That's the ownership side of things. You go out and buy a stock, whatever it may be, Disney, Costco, Walmart, whatever. You buy a stock, you actually own a fraction of the company. So let's take Costco for instance. You buy shares of Costco, you actually own a fraction of everything they own. The warehouses, the trucks, the products that they own. All of that stuff you own a fraction of. And as a owner of that stock, you get some benefits. Well, one, you're hopefully investing in the company because you believe in it or you've bought it at a value. Either way, you hope that its price in general is going to increase because of the job that they're doing. And if they're doing a good job, their price should increase over the long run. So as you own that, you hope to take advantage of the increase in price, along with any dividends that they may pay out along the way to you, a shareholder. So that's a stock. It's owning something. It's owning a fraction of a company. Now on the other side is bonds, and I call bonds loanership. So you don't actually own something, but with bonds you're lending somebody your money. Maybe it's a company, maybe it's a government or some other type of entity. You are loaning them your money to use for a certain purpose, and because you're letting them borrow your money, they're going to pay you interest as a return for doing so. So when we think about stocks and bonds, just break it down to the fact that it's ownership of something versus loanership, and either way there are benefits to having both in your portfolio, whether it's individual stocks and bonds or within mutual funds or ETFs or other types of investments depending on your situation. So keep that in mind, and hopefully that breaks it down a little bit easier for you. As always, I've been Mike Benasiak. This is Finance on Your Terms. Thanks for tuning in, and we'll see you next week.